Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Walmart.
If you find our talks useful, please consider subscribing, liking, and commenting underneath. Okay, let's unpack this. It is currently Friday, February 13th, 2026. And we are looking at a company that I think most people still think of as just, well, a grocery store where you buy cheap socks and bulk toilet paper.
It is the biggest grocery store in the world, to be fair.
Right.
But if you are still looking at it through that lens, you are missing one of the most interesting transformations in the entire market.
Well, looking at the chart, it certainly doesn't trade like a boring grocery store. I was crunching the numbers this morning, and this stock has surged, 179% over the last 3 years?
Right.
For context, the S&P 500, which has been on a historic run itself, is up 77% in that same period.
So it's doubling the performance of the benchmark.
Doubling it, exactly. So a boring brick-and-mortar retailer is absolutely crushing the indices, beating out plenty of high-flying tech names. Surprising.
Yes.
Is. You expect this kind of chart from a semiconductor company, not a place that sells milk.
It is surprising if you haven't been paying attention to the shift in their business model. This isn't just a defensive play anymore.
Okay.
It's not just where you park money when you're scared of a recession. The market is pricing in a fundamental transformation. They are effectively rewriting the playbook on what it means to be a retailer in the 2020s.
So let's dive into that transformation. Segment 1, the fundamental powerhouse. We've got some recent numbers to chew on that paint a pretty vivid picture.
We do. We are looking back at the Q3 FY 2026 numbers just to set the stage for what's coming.
Right.
And the headline number is massive. Revenue hit $179.5 billion. That is up 5.8% year over year.
And I want to pause there for a second. For a company this size, we are talking about the largest revenue generator on the planet. Moving the needle almost 6% is incredibly difficult. That represents billions of dollars in new money found in a mature market.
It is. It's like turning a battleship on a dime and accelerating at the same time. And they beat consensus estimates, which were sitting at $175.15 billion. So they cleared that by a wide margin.
Okay.
But the profitability story is even better. Earnings per share, or EPS, came in at $0.62, beating the expected 60 cents.
So they're selling more stuff and making more profit on it than Wall Street expected.
Yeah.
What's driving that? Is it just, inflation puffing up the numbers?
That's the lazy analysis, but no, it's volume too. Walmart U.S. comparable sales were up 4.6%.
Wow.
That is primarily driven by grocery and health and wellness. But here is the fascinating part, and where the tech pivot narrative really comes in.
You're talking about the e-commerce numbers.
Exactly. Global e-commerce growth was 25% in Q2 FY 2026, and that momentum has carried right through.
25% growth for a company that isn't Amazon and is working from such a massive base. That's incredible.
It is, and it's reflecting operational momentum. They aren't just selling online, they're fulfilling efficiently. For years, the knock on Walmart was that online sales were a money pit because shipping is so expensive. But they've solved that equation using their stores. This justified them raising their full-year guidance.
Okay.
They are now looking at sales growth of 3.75% to 4.75%, and an adjusted EPS of $2.52 to $2.62.
Which is funny because the analyst consensus was stuck at, what, $2.55?
Yeah.
So Walmart is basically telling the street, you're aiming too low.
Precisely. And if we look at the financial health, it's a fortress. We talk about quality stocks. Walmart has a debt-to-equity ratio of just 0.39.
Which means,
for the listener,
it means they aren't leveraged to the hilt. They are incredibly stable. In a world where interest rates are still a concern for many businesses, Walmart is sitting pretty. And their return on equity is 21.31%.
Translating that means for every dollar of equity shareholders have in the company, Walmart is generating over 21 cents of profit.
Yep.
That is highly efficient for a retailer. Usually retail is a game of pennies. It shows they are using capital incredibly efficiently while maintaining that stability. They have the cash flow to fund this massive omnichannel transition while still buying back shares and paying dividends. They don't have to borrow expensive money to grow.
Which brings us to segment 2, the moat. Because usually when we talk about retail, we talk about the retail apocalypse. Malls dying, department stores vanishing. But Walmart seems immune.
They aren't just immune, they are the ones digging the moat. Their advantage is what we call the omnichannel advantage.
Okay, buzzword alert.
Yeah.
Omnichannel. What does that actually look like on the ground for a regular shopper?
It means the physical store network, the supercenters, Sam's Clubs, aren't liabilities, they are assets.
Uh-huh.
They double as fulfillment centers. They are close to 90% of the U.S. population. When you combine that with digital fulfillment, you create high switching costs.
Right. If I can order groceries on the app and pick them up in an hour or have them delivered from a store 5 miles away, that's faster than a warehouse 2 states away.
Exactly. It solves the last mile problem that Amazon spends billions trying to fix. Walmart already owns the last mile.
Hmm.
And it creates network effects. The more people use it, the more data they have, the better the logistics get.
And we have to talk about the market position right now. The macro environment is, well, it's mixed. We saw that December retail sales were flat. People are nervous about the economy.
And that is where the trade-down effect kicks in. In a mixed economy, Walmart wins. When middle income or even higher income shoppers,
Yeah.
we're talking households making over $100 K, feel the pinch, they don't stop spending, they just spend at Walmart.
So they trade down from Whole Foods to Walmart.
Correct. And Walmart captures that volume. Compare them to Amazon. Walmart has the everyday low pricing and that physical proximity for fresh goods that Amazon still struggles to match perfectly.
Sure.
Amazon is great for dry goods, but people still like to see their produce or at least know it came from down the street.
And against Costco or Target, what's the angle there?
Costco is a beast, obviously, but Costco is a bulk membership model. It's a specific trip. Walmart competes on convenience and variety,
Okay.
and against Target. Walmart has scale in private label products and pharmacy services that gives them a different kind of leverage. They are effectively fighting a multi-front war and winning on almost every front.
So who is buying into this story? I mean, besides us talking about it, who's putting real money down?
The smart money is accumulating. We're seeing Fisher Asset Management adding to their stake. Vanguard and State Street have increased their holdings. Institutional ownership is sitting around, 26.8%?
That's a strong vote of confidence from the heavy hitters.
It is. Now, I will note a contrast here that we need to address. We haven't seen a big cluster of insider buying recently.
Okay.
In fact, some executives, including the CEO and EVP, sold about $27 million worth of stock.
Ooh, insider selling.
Yeah.
That's usually the red flag investors look for. Should we be worried the captain is leaving the ship?
Not necessarily. You have to remember context. I mean, executives sell for tax planning, diversification, buying houses, loads of reasons.
Right.
They already have so much of their net worth tied up in the company. But when you see institutions like Fisher and Vanguard loading up, that suggests a strong conviction in the long-term thesis, regardless of what an individual executive does with their personal portfolio for liquidity.
Got it. So the whales are swimming in, even if the insiders are rebalancing. Let's move to segment 3. Sentiment and technicals, the setup.
Right now, the stock is trading around $128.77.
And the analysts seem to like it here.
They do. Telsey Advisory reaffirmed their outperform rating with a target of $135. Evercore raised their target to $130 back on February 3rd.
So there's implied upside.
About 4 to 5% upside to those targets, yes. But the psychological aspect is what's interesting. If it clears those prior highs, you could see a breakout.
A blue sky breakout.
Yeah, traders love that because there is no overhead resistance.
What's the media mood? Are the headlines screaming buy?
I'd call it mildly bullish. You have headlines like UBS saying Q4 to support bull case.
But then you have the cautious ones asking, should you buy before Feb 19?
Exactly. It's not euphoric, which is actually good.
Yeah.
Euphoria is dangerous. That's when bubbles burst. This is cautiously optimistic. UBS believes the Q4 earnings will support the bull case, but there's enough skepticism to keep the price grounded.
But we have to look at the other side. We can't just be cheerleaders here. The bear case. What could go wrong?
There are risks. Competition is always number one. We mentioned Costco earlier. Their staffing model is incredible. They retain people. They have high morale. Walmart has historically struggled with turnover. And Kroger is going through leadership changes that could make them more aggressive on pricing. If Walmart loses grocery share, that's a problem.
And I saw something about a lawsuit.
Yes, the Estee Lauder lawsuit. They are alleging counterfeits in the Walmart marketplace.
That's the risk of opening up your platform to third-party sellers, right? It starts to look like a flea market if you aren't careful.
It creates a reputation risk. If you buy a premium product at Walmart.com and it turns out to be fake, you lose trust. It's a compliance headache.
Right.
But looking at the stock's beta, which is 0.65, it's very low volatility. The market currently views these risks as manageable annoyances rather than existential threats.
Okay, let's get to the main event. Segment 4. The Catalyst calendar. Circle the date. February 19, 2026.
The big date. Upcoming Q4 earnings. This is the key event.
What are we expecting?
Consensus is eyeing a beat on both EPS and revenue. The whisper numbers
The rumors on the trading
are
floor
higher than the official estimate.
and guidance. That's usually what moves the stock after the print.
That's the real key. For FY 2026, the street is looking for guidance of $2.58 to $2.63. That is ahead of the current analyst estimate of $2.55.
Okay.
If Walmart comes out and guides strong, hitting that upper range, that confirms the growth story is accelerating.
We also have these macro tailwinds. We've talked about the trade down, but there's also sector rotation, right?
Yes. Investors are getting a little jittery about AI capex, all that money being spent on ships and data centers without immediate returns. So money is rotating into defensives.
But Walmart isn't just a defensive anymore.
That's the beauty of it. It acts as a safe haven because it sells toothpaste and bread, but it offers growth because of the e-commerce and advertising segments. It's the best of both worlds.
The shield and the sword.
You got it.
Are there any wild cards, any rumors floating around?
There is some unconfirmed chatter about next-generation supercenter tests in Jacksonville.
Always Jacksonville. Why is it always Jacksonville?
Good demographics for testing, I suppose. The rumors are about new omnichannel efficiency drivers, more automation in the fulfillment areas. Again, speculative, but it fits the narrative that they are relentless about efficiency.
Okay, let's bring it home. Segment 5, the final verdict. What's the Smart Wealth score?
I'm giving this an 8 out of 10. Bullish.
8 out of 10? That is confident. Walk me through the pitch.
It's a defensive leader that is crushing benchmarks. Yes, it trades at a premium. A PE ratio of around 45x is not cheap for a retailer.
Wait, 45x? That's tech territory. That sounds expensive.
It is expensive if you view them as a grocer. But the efficiency gains, the moat, and that 25% e-commerce surge, that justifies it. You're paying for quality and certainty in an uncertain market.
Right.
You're paying for a company that can grow earnings even if the economy slows down.
So what's the strategy here?
Short term, there is a swing trade opportunity here leading into the February 19 earnings. You could capture that pre-earnings momentum as people position themselves for the beat.
And long term?
It's a multi-year hold. We call it omnichannel compounding. You just hold it and let them reinvest that cash flow into widening the moat.
So the elevator pitch is raise guidance, institutional accumulation, and a recession-resistant business model. It's a prime candidate for right now.
Exactly.
Here is my final thought for you to chew on. We talked about that PE ratio. If Walmart continues growing e-commerce at 25%, and their advertising business keeps growing, do we stop valuing them as a grocer and start valuing them like a tech platform?
That's the question.
And if we do, is 45x actually cheap?
That is the multi-billion-dollar question. If the market re-rates them, the upside is significant.
That's it for today's analysis.
Happy trading.
See you next time on Smart Wealth with Joshua.